I will start.
Good evening, everyone. Now we'll just play our ICI motto.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्वैता 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 एतद्वैता.
Good evening, everyone. It's a great pleasure to be here on behalf of WRC, wherein we are going to have today's webinar on transfer pricing. We have our esteemed faculty, Mr. Piyush Bafna, who's going to help us to understand the various controversies that too with the help of case studies on transfer pricing. Now we have with us our chairman of our WRC, Mr. Ankit Rathi, to further please address us.
हेलो दीपा मैडम, चेयरमैन सर थोड़ा दूसरे मीटिंग में मैम ज्वाइन नहीं कर पा रहे हैं.
Sure. So I hereby welcome my colleague, my coordinator, Ms. Pradnya, to please introduce our esteemed speaker for today, that is Piyush Bafna ji.
Am I audible?
Yeah, Pradnya, you're audible.
Yeah. Thank you, Deepika ji. Good evening, everyone. It's my pleasure to introduce Piyush Bafna ji. So, in a short, Piyush Bafna ji is a CA. Along with that, he's an advocate. He also holds a diploma in IFRS. He has done a diploma in international taxation, advanced diploma in international taxation. His firm, Piyush Bafna and Associates, is established in February 2015 and he's based out of Pune. Piyush ji is also a member of many committees. He's a member of Direct Tax Committee for the Chamber of Tax Consultants Mumbai for financial year 23-24 and 24-25. He is the nominated member of Committee of International Trade Services and WTO Committee of the WRC of ICAI for FY 24-25. He was the nominated member of Committee of Economic Laws of WRC of ICAI for FY 23-24. Along with that, he has acted as group leader in the International Tax and Finance Conference organized by the Bombay Chartered Accountants Society year 2021. Apart from that, he regularly publishes various articles on various leading websites such as Taxman, Tax Guru, Tax Sutra, LinkedIn, and he has a very vast experience of over 9 years. And his firm is engaged in rendering services in various areas such as income tax litigations, international taxation advisory, transfer pricing services. So over to you, Sir Piyush ji. We are all eager to hear you, and I might have skipped some things, so spare me for that. And the session is for all yours.
Thank you for such a kind introduction, and I am grateful for the opportunity given by WIRC for this to share the insights and more to learn from, because transfer pricing is not a science and it's not a one-to-one precise mechanism. It's always thought processes and it is keep on evolving. So I am also looking forward to have interactive discussion so that we all enrich each other, and in that process we grow. I'll just share my screen. Am I audible and visible properly?
Yes, you are.
Yes. Presentation is visible?
Yes.
Okay. So today's topic given is understanding the select transfer pricing controversies through case studies. So what I have done is the number of case studies and the transactions are so vast that if I have to cover everything, I think the time permission given is not sufficient. So what I have done is I have finalized some controversies which gives us the flavor which are there. And while doing so, I have also endeavored to see that whatever basic connotations of transfer pricing mechanisms are, they are all covered through one or other case study. So today's discussion, we are going to discuss about nuances as to how to determine associated enterprise, nuanced of deemed international transaction, and when there is no income, whether TP will be applicable or not, then how to characterize a particular entity and find the comparables, how to apply the other method, which is very peculiar to the India as a jurisdiction. Then the most challenging and most common dispute in the transfer pricing is the intra-group services, royalty payment, interest on overdue, and the list goes on. I think as and when time permits, we'll try to reach to the end. But if not, I think we'll go in a sequence because the earlier case studies are more important and more fundamental. The latter ones are more nuanced. With this, before we start, I think it's important to have a brief overview of the transfer pricing. So in transfer pricing, we have these 6 basic parameters which all play along through the course. The first and foremost, the transfer pricing is applicable when there is an international transaction between associated enterprise giving rise to the income. And if that is the case, then the tax officer or the TPO is required to determine the arm's length price for which he does the benchmarking. And while doing the benchmarking, he need to know as to what is the characterization or the FAR analysis, functional asset and risk analysis of the company. And while doing so, he should also give us the comparability adjustment if required. So all in all, the transfer pricing gamut is this. I have here excluded the specified domestic transfer pricing, which is not the subject matter of today. We are only going to discuss about the international TP. As well as we are not focusing on the procedural aspect as to whether the reference to TPO is proper or not, what is the time limit, whether the time limit 60 days, how to calculate that. There are also litigation on that front. However, those procedural aspect and specified domestic TP, these 2 topics are excluded for today's deliberation. We will focus on these aspects. So first and foremost, there has to be associated enterprise which enters into international transaction from which income is emanating, and to determine the arm's length for the same, then we have these 3 parameters given that you have to characterize, benchmark, and do the adjustments. Now, each of these having huge litigation in India as to when you should say the entities are associated enterprise, whether the transaction itself amount to international transaction or not. More so after the explanation, insertion of explanation in 2012, when there is no income, so to say the capital account transactions are there, whether the TP will still apply. And the other 3 are the nuances, like how to characterize the entity, which method to apply, and mostly when the officers don't give the adjustment. All these have led to the transfer pricing litigation. Through our case studies, we will delve into this. What I have done is I have devised these all aspects into case studies, and while going through the facts of the case studies, when we come to the analysis, we will be getting into the provisions and the settled judicial proceedings. So first controversy which we are going to look at is regarding the associated enterprise. For this is the fact which we are looking at, and then we will go into. So there is one Indian company which is engaged in a manufacturing joint venture with the German company. And under this proprietary technology and raw material are being supplied by this German company to the Indian company. The TPO has flagged transactions entered into between this Indian company. So mind you, the German company is not a parent company or not a shareholder in the Indian company. However, it is providing the technology and for which royalty payments are going out. What are the facts? The facts are like this. 70% of India's raw material are being supplied by the German company. There is a technical know-how which is being given based on which only manufacturing is happening in India. So Indian entity is not having its own manufacturing technology. For these Indian companies paying royalty of 10% on net sales. And again, 2 directors of Indian company are being appointed by the German company in the arrangement. Now, what is the dispute? Transfer pricing officer is saying that as Indian company is dependent on the German company completely, and there is a significant influence which German company can have over an Indian company, these two form the associated enterprise of each other. And therefore, the transaction entered into between them should be regarded as an international transaction and transfer pricing provision should be applicable. The Indian company stand is that the German company is not my associated enterprise. Whatever arrangement we have entered into, it's just pure contractual arrangement. And that foreign company, German company, is not exercising any control or management for that matter over the matters of Indian company. So what ultimately has happened is the transfer pricing officer is proposing to recharacterize these royalty payments and is also wishing to benchmark the profitability of the Indian company, because till date, the Indian company has not entered into or complied with the transfer pricing provisions. In this fact pattern, the question arises before us is whether the Indian company and the German company, can they be regarded as associated enterprise? Now let's come to the first point, like what is the definition of associated enterprise and what it deals. So section 92 capital A. Section 92 capital A defines who can be regarded as associated enterprise. There are 2 subsections. Subsection 1, which says whenever one entity participates into the management, capital, or control of other entity, that can be regarded as associated enterprise. Then to explain, we have subsection 2, wherein 13 specific situations are given, wherein they say that this will be considered as the associated enterprise, which includes, for example, more than half of the board is appointed by the other company, then that becomes your associated enterprise. So these we can basically call as deeming A's. The first and foremost controversy which is there is whether this subsection 1, which lays down the general parameter of management, control, and capital, and subsection 2, which gives the specific instances, if I satisfy one of the specific instances of subsection 2, whether that itself concludes that the parties are associated enterprise, or I need to check furthermore. So in this regard, we have the Orchid Pharma Limited Chennai Tribunal decision, wherein they have held that mere satisfaction of any of the 13 conditions in 92A2 is not sufficient. At the same time, you have to also satisfy the broader test of participation in either management or capital or control. What that means is both subsection 92A1 and 92A2 has to be cumulatively satisfied in order to conclude that the parties are A's. The next question arises, then what constitutes control? What do you mean by control? Because control is not defined in the Income Tax Act. So then the judiciary has evolved, and judiciary has said that the control can be of two types. One is a legal control, which we call de jure control, and one is the actual control, controlling the day-to-day operations and everything, which is called as de facto control. So the courts have held that whenever there is a de facto control, that means there is an actual influence over decision making, though there is no formal control in that manner, then that can be considered as a de facto control case. That was done in the case of Diageo, and in that ruling, the tribunal also emphasized that the control implies that there has to be significant influence over the operation or strategic decisions. If there is only satisfaction of one of the conditions, for example, more than 90% raw material is being procured from one entity. However, that entity is not controlling your day-to-day operations or strategic decisions, then you can still say that they are not the case. The next question which arises, the Indian entity in this case is arguing that what arrangement I am entered into, that technology collaboration arrangement through which I am manufacturing, that is just a commercial arrangement. It's a commercial transaction. It has nothing to do with determining the A. And it is without equity or without management control given to the other company. Now let's understand why this concept is coming. We have section 92A subsection 2, 13 parameters. One of the parameter which is relevant in this particular case study, which is 92A 2 subclause G. I have also highlighted it in red. What it says, when a manufacturing or processing of goods is carrying out by one enterprise, which is an Indian enterprise, which is wholly dependent on the use of know-how, patent, etc. of similar IP rights, then this can be considered as the associated enterprise. Hence, transfer pricing officer is saying that since your technology is wholly dependent on German company, you are the associated enterprises. While interpreting this particular clause, the Bangalore Tribunal in the case of Page Industries has held that even if 92A2 is satisfied, going by the literal reading, that yes, Indian company is wholly dependent on the use of know-how provided by the German company, you have to again go to 92A1 and to prove that whether there is control or not. In the particular fact pattern, the Indian company is operating on its own. Its day-to-day operations are being taken care by the management of the Indian company. There is no interference by the German company in that regard. And you are just paying the 10% royalty for whatever know-how they have provided to you. If that be the fact pattern, we can conclude that it is a commercial transaction, so to say, and it does not give rise to the relationship of associated enterprise between the two entities. So in this first case study, we have understood as to which test should go into to determine whether the two parties for whom we are analyzing the transfer pricing provision, whether they constitute associated enterprise or not. Now the Indian transfer pricing defines section 92 capital B, what can be constitute the international transaction, and they give the list. Then they have also added the explanation wherein different categories of sale of goods, services, finance, business restructuring, marketing intangibles, and all those things have been added. However, they have not stopped there. The Indian transfer pricing has one nuanced provision which is not present in most of the developed countries or in the OECD as well. And that is the deemed international transaction. Section 92B subsection 2 provides for a deemed international transaction. So apparently it may not be international transaction. The provision of law is deeming certain transactions to be international transactions. Now we are going to discuss a case study on these particular facts. The facts are like this. There is Alpha Manufacturing India Private Limited, an Indian subsidiary of a US company, Alpha Global Inc. These Indian companies engaged in manufacturing and sale of industrial components. The Indian company sources raw materials from US company as well as it's purchased the substantial quantities from the local Indian vendors as well. Now we have been given certain facts that purchases from the US is 50 crore and purchases from the local vendors by the Indian company are 30 crores. We understand based on our up until understanding that the transaction of 50 crore purchase from AGI qualifies as an international transaction. There is no doubt about it. The question is pertaining to this 30 crore transaction with local vendors. What has happened while doing the audit? The auditor has reported this transaction with the local vendors as deemed international transaction in Form 3CB, citing that there may be an influence by the foreign company, parent company, and hence it should be reported as deemed international transaction. The Indian company is contesting that see, auditor might have reported it out of abundant precaution, and that does not reflect the true and actual nature of the transaction. You have to prove that whether it has actually influenced or not. Mere the apprehension of auditor that it might have influenced cannot turn otherwise normal transaction into international transaction. TPO did not agree, and TPO says, no, your transactions are influenced by your foreign parent company through a prior arrangement. So what is their allegation is the foreign company and the local vendors had a prior arrangement which has been executed between the Indian company and the local vendors. And hence, he also benchmarked the transactions entered into with the local vendors by the Indian company, and addition of 5 crore is proposed through the benchmarking. In this fact pattern, we are to understand when a transaction should be deemed international transaction, what should be the parameters, and the nuanced aspect is when auditor says that it is a deemed international transaction, whether taxpayer assessee has to accept it as a deemed international transaction and then necessarily need to do benchmarking, or taxpayer can still contest that the transaction is not an international transaction. Let's go into the first aspect. Whether in this fact can we say that a transaction is a deemed international transaction? To be deemed international transaction, there has to satisfy the two conditions. Prior to that, the transaction must be between a associated enterprise and a third party, or the company and a third party. However, in backup to this, there has to be first either prior agreement between the associated enterprise, German company or US company, and the third party, the local supplier vendor, or the terms between the local vendors and the Indian company are in substance determined by your US parent company. If either of these two conditions are satisfied, then though the transaction is between Indian company and the local vendors, that domestic transaction can also be deemed to be the international transaction. Benchmarking provisions will follow. Now, having understood this, the question is whether my prices are being influenced. In the particular fact pattern, let's go to this aspect. Here, only based on the conjecture or a surmise or guesswork, auditor out of abundant precaution has reported as a transaction deemed international transaction. Here, one more practical point need to be noted that if I report a transaction, then at least I am saved from the penalty of not reporting, which is 2% of value of international transaction. The transfer pricing penalties are huge. So many times to save from the penalty exposure, the transactions are reported. However, whether that suggests or indicate that I have accepted it's an international transaction, the question is answered by the Bangalore Tribunal in the case of Commerce Industries India, wherein tribunal has laid down very important principle, and that principle is to determine that the transaction between Indian company and the local vendors were influenced by the US parent company is on the transfer pricing officer. So transfer pricing officer has to bring on record some material, evidence, email communication, or any of the third party inquiry which he has conducted, or search or survey proceeding for that matter, to conclude that there was actually the influence carried out by the US company over this transaction. Just the allegation that, okay, your 70% raw material, 50% raw material is from US company and 50% is from the local vendors, and you're a new company, how do you know when to source and which vendor to go from and source from? This means it all has been, the show has been run by the US company, parent company, and hence 92B2 provisions are applicable. This inferential process have been frowned upon by the Bangalore Tribunal, and they said that on the basis of conjectures, you cannot do the adjustments, or you cannot say that it's a deemed international transaction. More importantly, the point should be noted is this. Here, the assessee has not only contested on the legal point that we are not the deemed international transactions, they have also given the price comparison between the price of purchase from the group company, parent company, as well as from local vendors, showing that the pricing between these two are very competitive. So there is no question that I have been given any advantage in any of the arrangement. That is a very crucial fact which taxpayer has brought on record. Similarly, they have also submitted as an evidences that the negotiation with the local vendors as to at what price we will buy, what discount will be given, how much quantity should be purchased, all these negotiations were done by the Indian company on its own without the interference of the associated enterprise. Having brought on record these factors and transfer pricing officer having nothing with him, ultimately it has to be decided that the transactions are domestic transaction between normal third party scenario, and they need not be considered as a deemed international transactions. And once that is the case, they need not be benchmarked, and hence whatever transfer pricing adjustment which the TPO has proposed of 5 crore rupees in this example have been rightly quashed by the tribunals. So it is very important to know this deemed international transaction cannot be invoked based on the inference or human probabilities. This is a fact which has to be established, which has to be proved, and for this there has to be some material available. If that is not the case, then a stand can be taken that such transactions should not be considered as deemed international transaction. Now we have completed two legs, that there has to be associated enterprise, there has to be international transaction. Then we have also saw that the third element of transfer pricing is very important. We move on to the next case study as to there has to be income arising from the transaction, international transaction. Why so? If there is no income which is emanating between the international transactions entered into by A and an Indian counterpart, Indian group company, why the tax officer and tax department is undertaking this exercise of transfer pricing? Because, okay, they determine the price of transaction instead of 50 should be 80, but unless that 30 rupees, 80 minus 50, 30, translate into the addition to the income, the purpose is not solved and the income will not be taxable. Hence come the very interesting case study, which is when transfer pricing provisions will be applicable if there is an absence of income. Now let's go to the fact of this case study. The Indian company is owned by the US company. There is an issue of equity shares at premium by the Indian company to the parent company. So share of rupees 10 is issued at a premium of 9,000 to the parent company. Transfer pricing audit is ongoing of the Indian company, and the TPO determined that the arm's length price of these shares should have been 15,000 rupees per share. He is now proposing an adjustment for the shortfall of the premium. Basically 6,000 rupees per share is the adjustment he is proposing, because he's saying that is income, and since Indian entity is deprived of that component, that should be treated as deemed loan given by the Indian entity to the parent company, and now he's computing interest, notional interest, as an adjustment, TP adjustment. Let's also have a look at the facts of the case. The issue of shares is happening in November 2024. 6,000 shortfall adjustment is being proposed. What is the bone of contention? The taxpayer is contending that, see, the transaction is not sale or service. The transaction is issue of shares. Issue of shares doesn't give rise to any income. This is a capital transaction, not generating any income, and hence it is out of the purview of Chapter 10, which is a transfer pricing provision chapter of the income tax, and hence whatever addition or adjustment you are proposing is without jurisdiction or not applicable. Now let's test the arguments taken by the assessee and what is the law provisions. The first and foremost provision, which is very important to keep in mind, is section 92, subsection 1. This provision, I have also reproduced it in the italics. It says, any income arising from an international transaction shall be computed having regard to ALP, arm's length price. It says any income. So the foundational provision of transfer pricing says there has to be some income emanating from the international transaction. Then only the provisions will apply. If taxpayer can prove that no income whatsoever can arise from the transaction, then you can very well contend that transfer pricing provisions are not applicable. Similar somewhat situation has arisen in the case of Vodafone India Service Private Limited, Bombay High Court, 368 ITR 1, where exactly the same issue, issuance of shares, was under dispute, and transfer pricing officer said that you have charged less premium, you should have charged more, and proposed the transfer pricing addition. The Bombay High Court came down saying that, see, this is a capital account transaction. It does not give rise to any income. And since it is not giving rise to any income, transfer pricing provisions will not apply. Now, mind you, it is very important to note, when this judgment is given in 2014, and it must be pertaining to some older years, 2000, 2004, that time the provisions of section 56 to 7B, or so to say 56 to 10, were not there on the statute book. And hence, it can very well be said that when you are issuing shares, there is no income which is arising. But post introduction of section 56 to 7B, if you are issuing securities at a premium, then that premium can be considered as an income of the Indian entity if you are not able to justify through your valuations, right? So there is a provision available post 56 to 7B that even if it is a capital receipt, that can constitute your income under 56 to 7B. And if that be the case, in my submission, the judgment of Bombay High Court may not directly apply in the case of capital issuance of shares and determination of premium. However, interestingly, in our fact pattern, the shares are being issued on November 2024. Now, what has happened? The provision of section 56 to 7B has been omitted, or its application has been stopped on the clock of 31st March 2024, meaning thereby any shares issued post 1st April 2024, the provision of 56 to 7B are not applicable, meaning thereby there is no deeming fiction now, which creates that if there is any surplus of premium on issuance of share, that will be considered as income of the Indian private company issuing the shares. Hence, I think the ratio laid down by the Bombay High Court again has become applicable from 1st April 2024, and we can again take the stand that if I am issuing shares, Indian company is issuing shares at a premium, and say that premium is lesser than what I should have got from the parent company, then the provisions of transfer pricing are not applicable. AY 25-26 and onwards, they are not applicable. This position is on principle that if no income, no transfer pricing provisions, this provision is also being supported by the ICI guidance note on section 92C. Here, I will just give a food for thought and we will not delve much into it, but that will be a crucial element. This is one aspect, that shares having value of 15,000 are issued at 9,000. That means the recipient is being benefited to the extent of rupees 6,000 per share. Now, question is, we also have a provision which is 56 to Roman 10. 56 to Roman 10 says that whenever a person, any person, they don't say the resident person. So even non-resident person is also, that 56 to 10 is applicable. Any person who receives any property, money, immovable property or movable property, share security will be movable property. So whenever a person receives any movable property for without consideration or less than consideration exceeding 50,000 rupees, then that will be its income. The question is, in the particular fact pattern, the assessment is of the Indian company. So we can very well take a stand that, sir, no adjustment in the hands of Indian company. But can the department today, tomorrow, take a stand and issue notice to the US parent company saying that, sir, section 56 to 10 is applicable to you in India, and the 6,000 rupees per share is your income under section 56 to 10. This has left to be taxed, and hence it will be, we are issuing you a notice. I think this question still remains. So while arguing from the Indian company's point of view and transfer pricing provisions, we should be mindful, and we should also see the provisions of respective double tax avoidance agreement, which deals with other income. Because most of the treaty have a provision that other income will be taxable only in the country in which the resident is. So for example, you're a US company, it will be taxed in US. But there are certain treaties which says that that income can also be taxed in the country in which it is arising. US is one such example wherein other income taxation rights are also given to both countries, country of resident as well as source country. Hence, it is interesting to see and ultimately analyze and conclude whether 56 to 10 can be triggered in the hands of foreign parent company, US company, because India also have a taxing rights of other income. That I think food for thought, but in our case study, the TP provisions should not apply. Now, having seen the fundamental disputes or the issue on the fundamental international transaction and income, let's go to the hardcore transfer pricing provisions, which is how to determine and how to characterize a particular company and how to select the comparables thereafter. See, characterization means based on my functions, asset, and risks, whether I am a full-fledged manufacturer or I am a licensed manufacturer or I am just a toll manufacturer. Similarly, for a distributor, whether I am a full-fledged distributor or I am a normal risk distributor or I am just a low risk distributor. Similarly, for services, whether I am just cost plus captive entity or I am a full-fledged service entity. These kind of these we are talking as a characterization. This characterization is dependent upon the FAR analysis. In this case study, we will see how to determine the characterization and how the characterization impacts the benchmarking process and the comparables to be selected. So we have the facts. Support Solution is an Indian subsidiary of US company. It is providing IT-enabled service, ITS, like back office, customer care, basic data processing. It is charging cost plus 12%, and it is characterizing itself as a low-risk captive service provider because it is catering only to the US parent company. Tax authority, TPO, is saying, no, you are not a low-risk captive service provider or BPO service provider, but you are a knowledge process outsourcing service provider, KPO. Why? He says there are specialized analysts in your company who are doing the higher value services, and hence you cannot be compared with the persons who are generally known as the BPO, low value service providers. What are the key facts? My total cost incurred by Indian company is 200 crore. Agreed pricing is cost plus 12%. So it has offered profit of 24 crore, revenue of 224 crore. It has characterized itself as a BPO service provider. Now TPO is saying you are a KPO. Because of this, he is also rejecting my comparables. And to find out the comparable for KPO, transfer pricing officer is applying certain additional filters like turnover filter, employee cost filter, R&D filter, receivable filter, export sales filter. And based on this, he has rejected some of my comparables and he has also found out some new comparables. With this, the exercise TPO has undertaken, his margins now, arm's length margin is cost plus 25%. Since I have offered 12%, he has proposed the addition of 26 crore rupees. So two things he has done. He has changed my characterization from BPO to KPO. And to find out the comparable now for KPO, he has applied certain filters and tried to find out the new comparables with high margins. In these facts, what issues arise for our consideration? The first and foremost issue is how to characterize the entity and whether he is right to characterize BPO as a KPO. What shall be the parameters? The jurisprudence is settled. In order to characterize any entity in any manner, it will depend on the functions, asset, and risk profile of the entity. So broadly, BPO's functions are routine, process-driven, like support and payroll processing. It has like basic IT infrastructure, standard softwares. Its employees are not very high skilled. They are process-oriented staff and it is to focus on operational efficiency, and it takes very minimal risk. Its risks are basically restricted to the day-to-day operations it is carrying out and to how to reduce those operational inefficiencies. Contradiction to this, KPO, their functions are very complex. They are judgment-based, like financial analysis, legal research, business strategy, fraud detection, or forensic audit. These are all the high value functions. Market analysis, equity research, these are all KPO services functions. Their assets are also, they have their own proprietary tools, they have their databases, they have their intellectual property developed, their knowledge center they have. Employee profile also, if we see, they are very high skilled professionals with domain expertise. Unlike BPO, who is very routine, ordinary staff, can come, can go, can be easily replaceable. And these employees in KPO focus on innovation, problem solving, and their risks are very high because decision making and analytical errors are also involved there. Now, what TPO is doing in the present facts is, he is saying, you are not a BPO, but you are a KPO. To see this, I have to see my functions. And when I see my functions, they are very clear. Back office support, customer care, and basic data processing. If my functions remains the same, if my staff is also low skilled and process oriented staff, I am not satisfying the FAR of KPO service provider. And if my FAR is not changing to KPO, then TPO cannot simply say that you are not a BPO, but you are a KPO, because my FAR analysis is not supporting that particular conclusion. In this regard, we should also be referred by Mars Global Center Special Bench ITT judgment, wherein they said that there is a distinction between BPO and KPO, and that distinction is based on the value addition. The entities may be providing the routine processing services using sophisticated tools, but just because that sophisticated tools or IT infrastructure will not convert you from BPO to KPO. So with this, we can still conclude that I am not a KPO, but I am a BPO in the present facts. Now, what next issue? The next issue is, which is very important, comparable selection and benchmarking. If transfer pricing officer concludes that I am a KPO, then my comparable should also reflect the KPOs. But if BPO, then BPO. Now, as we have concluded that I am a BPO only, but now he is proposing the comparable which are KPO. How should I go about it? Should I simply call or ask that these comparables be rejected and the BPO comparable be substituted? Yes, one option can be that. Second option is, can I say that the margins of KPO comparables are so high and they are not comparable to me? Yes, very well, yes, because higher margin shows higher risks assumed by the comparables, and BPO service provider is not doing that. We have also seen that to find out the comparables, the TPO has applied multiple filters like turnover, employee, R&D, etc. The question is whether application of these filters is appropriate to find out the comparables. For this, we have to go to the Rule 10B and Rule 10C, which says that apple should be compared with apple and not with the banana. So I have to see that with whom I am comparing, that should also be in the similarly placed situation, then only it can be compared. Various tribunals and courts have held that turnover filter, for example, my turnover is 5 crore, I am into IT business. If I have to compare myself with the Infosys, whose turnover is 5,000 crore, just because it is IT company, it will be wrong because their scale their synergies and their advantages are way different than mine. Hence, turnover filter is acceptable. Whether it should be 10 times more, 10 times less, or it should be for IT company 1 to 200 crore, then 200 to 2000 crore, 2000 to and more. We have various judgments. There is no, what you can say, consistency. However, generally 1 times to 10 times of your turnover. For example, my turnover is 5 CR, then 50 lakh to 50 CR, that is the turnover range. And any company satisfying that should be my comparable. Since we are talking of IT company, employee cost is the most important cost component. And hence employee cost filter is relevant filter which should be applicable. R&D filter is also important because if any company having more R&D expenditure, that means that company is not merely a BPO service provider, but may be involved into the development of a software product. And hence, software product company should not be compared with a BPO service provider. Then the questions about whether the export sales filter is appropriate. Here, your 100% sales is to your group company. So TPO says, I should apply the filter of 75% of your sales should be export sales. Then only the company is comparable. Yes, ideally that is the right approach because that gives parity between, because the margins of export oriented companies and margins of a company catering solely to domestic market may vary. However, if number of comparables are not many or the data set which comes out is not very appropriate, in a sense doesn't give good picture of the industry, then I think this filter can be tweaked because this is not as per the law, but we are going by the basic principles. So application of filters on broad basis, principle basis, yes, that is the right approach. Then comes the last question. Assuming the comparable selected by TPO as a KPO service provider remains, what is the alternative? Can there be any other alternative available to taxpayer? I can say, see, I am a less risk taking company, and the comparables you are selecting are their high risk taking companies. So their margins would obviously higher. So when you are comparing their margins with me, I should be given the risk and asset adjustment, which is my risks are lower. So my risk should be to an extent of proportion be reduced and it should translate into the margins. I think that approach is being sanctified in the case of visual graphics and many other judgments wherein risk adjustment has been allowed to the taxpayer, and it has been held that the say arm's length margin comes to 25% for KPO, then to translate to BPO, say risk adjustment of 7% is given, and then your margins are kept at 18%, and then accordingly it can be compared. So you understand these are the various issues which comes through characterization, and characterization depends on your part. Once that is done, it also affects the selection of comparables and ultimately the determination of arm's length price. With this, let's move to the next case study. As I have said earlier, we have, as a India, we have the innovative sixth method. Generally, all across the world, we have 5 methods for benchmarking. Comparable uncontrolled price method, CUP. Then we have resale price method. Then we have cost plus method. Then we have TNM method, profit split method. These are the 5 world acknowledged method. India has introduced somewhere around 2010 that we'll have one more method, which is other method. Most often we see taxpayer applies TNMM or some other method, recognized method. TPO rejects that and says, I apply the other method and determine the ALP of your transaction at nil, 0 value. Hence, it is important when the application of other method. The facts are like this. The Indian company is a pharma subsidiary, and it is providing the pharma vigilance and drug safety testing services. What has happened, this Indian subsidiary has acquired the ongoing business of another local Indian business, Quantum Solution India, for 600 crore, which included the unique intangible asset like trade name, customer contact, and customer relationship. Having acquired the same, Indian subsidiary has sold this intangible to their associated enterprise in Ireland for 400 crore, because this group, Pharmatech Group, have all the IPs located in the Irish A. The question is, you have acquired for 600 crore, the IPs are going for 400 crore. TPO is saying, what has happened? The Indian company has applied the other method to benchmark the transaction. TPO says, I don't accept your other method, which is based on the valuation, independent valuation report which you have obtained. I don't accept that. Which method TPO proposes? TPO proposes the method of cost plus method, imputing 25% markup on the transaction. And so 400 crore is the sale of intangible. On this, he impute 25% markup, and accordingly, 100 crore addition is proposed. What are the questions which are emerging from these facts? We have the concept in transfer pricing provisions, which is the most appropriate method. Rule 10C talks about it. So TP regulation nowhere says which method to be selected in which transaction. For goods, this method, service, this method, no. Law doesn't prescribe that. Law only says that in the given facts of a particular transaction, which is the most appropriate method, that method has to be selected. Now it depends on the facts and circumstance of each transaction. Generally, when there is a unique intangibles involved, the traditional methods like net margin method, profit methods, they fail because that is not being captured in the other comparable transactions. And hence, other method, which is based on the valuation reports of independent valuer, can be of very great significance. Even the ICI guidance note says that other method is apt for benchmarking the unique asset transactions compared to the CUP or TNMM method. Having said this, what in the current fact pattern taxpayer has done, has taken the independent valuer report, which is based on the discounted cash flow method, DCF method, or any other recognized method, so to say, relief from royalty method. TPO has not assigned any reason or found fault in the TP report as to, valuation report, as to this assumption is wrong, this rate of return is wrong, or whatever. These kind of remarks are not given by TPO. He simply says, I don't accept this, I go to the CPM method. Then comes the next, can he do so? Deepika ji, you want to say something? Deepika ji, can you mute yourself? Is my voice better now? Deepika ji, can you please mute yourself? Okay, I think she has muted. Okay. Now next issue arises. He is rejecting my other method. He is going to CPM method, but he has to also check whether the CUP method or TNM method should have been applied. We know CUP method requires the most strictest comparability standard. That exactly same comparison has to be there only the CUP method. But since unique intangibles are involved, which is like proprietary IPs, you will never get a CUP. So CUP method fails. Then comes the TNMM. Generally, it's a method of last resort. We compare between all the comparable companies, net margins, and if that net margin is within the range, we say it's at arm's length. However, how will we determine the impact of this one-off transaction of unique intangibles? So this transaction-specific nuance doesn't get covered through TNMM method. And hence, in the present fact pattern, even TNMM method is not correct method. So we have rejected the CUP method, TNMM method. We have also seen that the RPM method is not applicable because we are not talking of goods. Let's come to the TPO's proposition, which is the CPM method, cost plus method. Rule 10b prescribes that CPM should be good for transactions of provision of goods or service. However, our case, the transaction is of pure intangible transfer. Hence, going by the rule 10b also and ICI guidance and OECD guidance, the CPM method, which the learned TPO has applied, fails because one more reason, there is generally no cost of production involved for intangibles, which is for goods or service. Hence, TPO CPM is flawed. CUP is out, TNMM is out, PSM profit split method is not applicable. Then with this analysis, we come back to this, that in the present fact pattern, valuation-based method is the right and most appropriate method, and hence other method which assessee has applied is the right method, and TPO should not have tinkered with the benchmarking. That's how, in this case study, we have discussed how the nuances of most appropriate method occurs, and when to apply other method and when not to apply other method. With this, let's go to the very interesting, most debated, most common transfer pricing adjustment and transaction, which is intra-group services. We have the head office, we have the parent subsidiary company, many transactions like IT, finance, legal support, etc., accounting support transactions happen, for which cross-charge come from the parent company to the Indian company. The question is, during the transfer pricing assessment, you have to prove and justify the ALP of those transactions. The case study deals with this. So we have Global Tech, which is a subsidiary of US company providing IT support, HR management, and strategic consulting. It has raised the invoice of 10 crore, and Indian company follows the cost plus 8% markup model and TNMM benchmarking. So it has done that. Now, in the TP audit process, TPO says there is no commercial rationale for incurring all these kind of 10 crore expenditure for group company. And you have also failed to demonstrate the receipt necessity and the benefit derived from these services. It is a, what you can say, means to shift profit from India to US. Which were the services involved? First was the IT support, second was HR management, and third was strategic consulting. TPO says all three tests, receipt, need, and benefits are not satisfied. And hence, I determine the ALP at nil, 0. What issues arise from this fact pattern? The first and foremost is, whenever there is a transaction of intra-group service, there are three terms which are generally talked about. First is the receipt test, second is the need test, and third is the benefit test. We will discuss each of them, whether all three need to be satisfied, or only two need to be satisfied, or only one need to be satisfied. Receipt test means the taxpayer or the Indian company has to prove that yes, in fact, it has received the services. Many times only the paper invoice is being issued. However, no service is actually received by the recipient. If that is the case, then receipt test fails. So there has to be proof that service is actually received. Then comes the second test, need test. Was the service which you received was necessary? There are multiple dimensions to determine whether the service was necessary or not. We have the judgments from the courts which says that the tax officer cannot sit in the armchair of a assessee and determine, okay, it was necessary or not. It could have reduced. I could have procured the same services at a lower cost domestically. Why to pay for a foreign company? Because there are certain aspects like commercial expediency. Some services, you have a global centralized team, IT infrastructure of your parent company. Obviously, you will avail the service from your parent company than paying again to a third party. Very important to see is whether the service which you are getting, in our case like IT, HR, strategic consulting, are they integral to the business assessee is carrying on? If they are integral, generally we can say that need test is also satisfied. And need has to be always seen from the recipient's perspective, not from the provider's perspective. Whether the recipient needed it. If yes, that's all. Then comes the most litigated aspect of this, the benefit test. Whether I need to satisfy that the service which I have received from my group company, which is needed also, whether it has benefited the Indian company, and if it is not benefited the Indian company, whether the ALP of that transaction becomes zero. We have numerous judgments from the tribunal on this. We don't have any authoritative High Court ruling as of yet. And the tribunal judgments are, so to say, divided. Many judgments says and rules in favor of taxpayer that once you prove you have received the service, that is sufficient. Benefit test need not be seen. However, equally, there are certain rulings from tribunal which says that benefit test is an inbuilt mechanism in the arm's length determination. And unless you prove that some benefit is being given to you, the service was not duplicative, the service was not for namesake and sham transaction, you have to prove what economic benefit you have derived from the same. If you don't do that, then the ALP officer is very well in his power to determine ALP at nil. Considering this judicial jurisprudence which is available, our suggestion is benefit test should be ideally documented in the transfer pricing study report, because that supports the contention before the lower authorities. Otherwise, you have to go in the litigation before the higher forums. There is one very nuanced approach that the Indian company is paying 10 crore rupees to the US company. This US company has already offered this 10 crore rupees as fee from technical service in its Indian ITR and offered 10% taxation on the same on gross basis. Question is, can still TPO in the case of Indian company determine the ALP of the said transaction as zero? So we have this, we have one judgment from the Kolkata Tribunal of AT&T Services, wherein they have beautifully brought out this, that we have only concept of single arm's length price for a single transaction. If we accept departments this approach, in the case of AE for similar transaction, the ALP is 10 crores, but for the same transaction in the hands of Indian company, ALP is nil. Once the US taxpayer or the AE has offered it for the Indian taxation, ideally there should not be any TP adjustment. This is also been view echoed by the Pune Tribunal. So this added aspect should also be kept in mind while dealing with the intra-group services. With this, let's go to the next category of transaction, which is royalty transaction. This generally is only applicable in the case of manufacturing companies and not to the service or trading companies. Facts are very simple. The Indian company is into the manufacturing of electronics sector. It's a full-fledged licensed manufacturer. It is selling the manufacturing and selling the products in the brand name of Global Tech in India. And it is also exporting to other jurisdictions. Since it is dependent on the parent company, it is paying royalty for the same for use of know-how, technology, and brand name. The arrangement of royalty is like this. It is paying 5% fixed royalty on domestic sales. So sales happening in India, it is paying 5%. And whenever it is exporting to other jurisdictions, it is paying the royalty of 8%. TPO, like how the Indian company has benchmarked this, Indian company has benchmarked royalty transaction by aggregating with other transactions. So it has not separately benchmarked the royalty transaction. It has compared its net margin with the comparable margins, and that was at arm's length. They said everything is at arm's length. TPO says, no. We have to follow the transaction-wise benchmarking approach. Royalty is a separate and specific transaction, so we will benchmark it separately. Then he conducts a search on a database like royalty stat or etc. and find out the comparable royalty transactions. He says the arm's length rate of royalty should have been 2%. And accordingly, whatever excess you have paid, 3% and 6%, he is proposing to deny the same. Indian company saying, I am a captive unit, I am fully dependent on them, and it's the industry practice that I am paying royalty, so this should not be denied, and my transaction should be considered on aggregation basis under TNMM. You cannot compare all the transaction under TNMM and only pluck out one transaction of royalty and benchmark it separately. TPO ultimately refuse and make the addition. Now, what are the issues and how to tackle them? The first and foremost issue is whether TPO can carve out royalty as a separate transaction and benchmark it separately. So there comes the principle of aggregation of international transaction. Ideally and principally, each and every international transaction should be benchmarked independently. However, if the transactions are so interconnected, interrelated, interdependent, and if I segregate them from each other, then the picture which is emerging is divorced from the reality. And those transactions are so intertwined with each other, then the courts have said that all these transactions should be aggregated together, seen together, benchmarked together. For this, we have Delhi High Court as well as various tribunals. Hence, the first issue is TPO should not have divorced royalty transaction separately. Second important aspect comes from this case study is we have seen the entity was on cost plus remuneration model and it was a captive entity. So whether this nature of captive unit affects the benchmarking of royalty? See, when I make the payment on cost plus basis, this royalty goes into the cost pool, and on this also I charge my markup. So impliedly, royalty transaction is already benchmarked in my cost plus remuneration. And if that be the case, we can very well argue that this should be charged. And the royalty transaction is at arm's length. Second important aspect is department's contention can be like this. If you are a captive entity, your risks are lower. You have been given a very safe margin. If that is the case, how can you make the royalty payments? You should not have paid, your parent entity should have borne it. The case is like this. The captive entity is using the technology, manufacturing the goods and selling it in the domestic market as well as exporting it. So sale is being done by the captive unit. And if that be the case, the parent company's brand name and technology which is being used for this sale, parent entity on basic principle, commercial principle, cannot be deprived of the adequate remuneration for the same. And hence, royalty is also very well justified in case of cost plus captive entities as well. Next issue arises how to benchmark the royalty. So we have already seen there are two most famous methods. One is the CUP, comparable uncontrolled price. Second is TNMM. In the present facts, TNMM is the ideal method because royalty is linked to the manufacturing. However, otherwise, the search should be run on the specific database of royalty stat or other database, and the comparable percentage of royalty, 2%, 4%, 6%, whatever, that percentage has to be found out, and accordingly, that transaction should be benchmarked. With this, we come to another interesting point and transaction, and which is giving rise to multiple litigations, is interest on overdue receivables. We will directly go into the facts of the case because it is easy to understand. So we have Finance Tech India, who is a captive service provider providing ITES services to the US parent. Remuneration is cost plus 15%. Now, the audit for FY 23-24 is ongoing, and auditor notes that you have receivable from the AE which are significantly overdue. So average period, agreed credit period with the AE is 60 days. However, there is a delay of 120 to 250 days beyond this 60 days period. Now, auditor is saying this interest on overdue amounts to international transaction, and he is imputing or asking you to impute the notional interest on the same to comply with 92B provision. The Indian company's stand is, it is not a standalone international transaction. I have already factored in that my AE will pay me a later moment of time, and hence I have increased the pricing, and accordingly my pricing of service has taken care of this aspect. However, the auditor is not ready to accept this, and auditor has reported interest on overdue receivable as an international transaction in form 3CEB. And he has also imputed the arm's length price by applying the notional interest rate of 12% per annum, which is the SBI PLI rate, and proposed the TP adjustment of 60 lakh rupees. We are faced, because this has happened by 31st October 2024. Now we have to file our return by 30th November 2024. As a company, we have to take a stand in this fact pattern, whether what auditor has done is right or company can still take some different stand. The first question arises whether the interest on overdue receivable is a separate international transaction, because I have not entered into any agreement with my AE that yes, I give you additional credit period of 150 days. That is not the case. So whether it can be considered as a separate international transaction, or we can say it is a part and parcel of the main sale transaction, and it is taken care in the sales transaction. We need not separately look at it. Here also we have numerous judgments from tribunal giving a diverse view. One extreme of the view is it is not an international transaction itself, despite introduction of explanation 1C to section 92B. And we have the other extreme of the tribunal judgment, which says it invariably is the international transaction. You have to take care and determine the transfer pricing. In my view, the answer is not very black and white. The answer depends on what is the nature of delay. If the nature of delay is such, which is ordinary, for example, your industry practice is such that credit period has to be given of 6 months, then you cannot expect that only if my AE after 60 days, they should have repaid me back. If industry giving is 6 months credit period, then I should also be given 6 months credit period. And if I am realizing within that time, it should not consider separate international transaction. However, if you have to receive your sale invoices for say more than 3 years also, 4 years also, then I believe it is nothing but a transaction or implied financing given by Indian company to the group company. And in that situation, it may warrant reporting as an international transaction. Next question, we have seen in the fact the Indian company is a cost plus captive service provider and its remuneration model is cost plus. Now, if I am a cost plus entity and I impute, the question is, captive entities' risks are very limited and they have been given the guaranteed markup. So even if there is a delay in receivable, ideally the argument can be taken that it is already being factored in the cost plus markup which is agreed. And now nothing more should be paid to the captive entity because it's a risk insulated entity. And hence no separate adjustment is warranted. In the case of Kusum Healthcare, it has also been held by the court that if you apply the working capital adjustment to factor in the receivable and payable position of yours and comparable company, in that situation, interest on overdue receivable should not be considered a separate international transaction, or even if it is considered, you need not compute separate ALP for the same. One more issue, two more issues arise. Working capital we have already discussed. How to benchmark? For example, I conclude that my delay is prolonged 3 years more, so it should be international transaction. I accept this proposition. Next question, how to benchmark? Should I benchmark it as if it's a loan? And since it's an India receivable, whether I apply the SBI PLI rate or I apply the foreign denomination rates like SOFR or MIBOR. LIBOR is no more there now. The answer is given by the Delhi High Court in Cotton Naturals, wherein they have held that interest should be benchmarked based on the currency of the transaction and not the location of tested party. So since the currency of transaction, for example, the invoice which you have raised, Indian company has raised or parent company, if it is in USD, then the interest rate should be benchmarked for the USD currency. That means in the USA market and not in India, though India is a tested party. This is the guidance given by the Delhi High Court. With this, let's move to the next interesting aspect. One more area of huge litigation under transfer pricing is corporate guarantee. We'll directly go to the facts because facts are pretty clear. We have German Pharma, a German pharmaceutical company, who has given the corporate guarantee to support the loan facility which is availed by the Indian subsidiary, Indi Pharma, from the Indian bank. This guarantee has enabled Indi Pharma to get favorable loan terms like reduced interest rate and higher term. The loan amount is 10 million, approximately 85 CR. The German pharma company has not charged you any corporate guarantee fee for the same. Interestingly, it is not the TP assessment of an Indian company. The TP assessment is picked up of a German pharma company for other transactions which they have reported. The transfer pricing assessment of German company is taken, and this case has happened live in one of my clients' case, wherein the foreign company's assessment was taken up, and the corporate guarantee we have only reported. We said the ALP 00. The tax officer says no. Corporate guarantee is a valuable service. How can you not charge for it? The arm's length range for this is 1 to 2%, and say median is 1.5%. The TPO has made the addition of 1.5% in the hands of foreign company. Since India don't have the corresponding adjustment regime, which means if there is an income in the hands of foreign company, equally there should be expenditure in the hand of Indian company for corporate guarantee fees. Indian entity is deprived of expenditure, and the foreign company is saddled with the income addition. Now, in these facts, what questions arise? The first and foremost, and which is perennial, whether corporate guarantee is an international transaction under section 92B, because if it is not international transaction, I did not go into benchmarking, I did not go into what rate, and everything goes away. The main argument for saying that it is not an international transaction is I have reproduced section 92B over the screen. It says transaction of nature, purchase, sale of tangible, intangible property, service, lending, borrowing money, or any other transaction having a bearing on the profits, income, losses, or assets. So these are the four main categories. All these, each category they have defined in explanation to section 92B, A, B, C, D. So C category is lending or borrowing, which is this capital financing, including any type of long-term borrowing, lending, or guarantee during the course of business, or any other transaction having bearing. The question is, if my parent company is not charging me anything for providing corporate guarantee, whether there is any bearing on the profits, income, loss, or asset of such enterprise. The argument was taken, and there is a judgment in the case of Ahmedabad Tribunal in the case of Micro Inc. Limited, 157 ITD 132. The court said there is no bearing on the profits or income when you don't charge for it, and hence it doesn't form or fall of section 92B. However, similar argument was taken in the case of Redington India Limited, and Madras High Court has turned it down, saying that it is an international transaction. The logic taken was, till the time corporate guarantee becomes enforceable, for example, Indian company defaults, corporate guarantee doesn't, the implication doesn't arise. So it is a contingent liability, and contingent liability cannot have bearing on profits. TPO said it has bearing on profits in future. But if a liability is contingent, then even it cannot have a bearing on future profits. Only if the liability is crystallized, it may be payable in current year or future years. Fortunately or unfortunately, now that this argument is being turned down by the Madras High Court in the case of Redington, and probably we can take the stand that it should be international transaction. However, there is one more layer. Can I say that the corporate guarantee which my parent company is giving is nothing but to protect its own shareholder interest? Because if Indian subsidiary gets good loan, good funding at lower rate, the Indian company will perform better. So Indian company's profits will be higher, and that profit will ultimately go back as a dividend to the shareholders. So my parent company, when giving the corporate guarantee, it is not doing charity to the Indian company. It is doing for its own interest and benefit. If that be the case, we have one concept under the OECD, which is a shareholder activity. If any service or activity which is happening, which is of the nature of shareholder activity, then it doesn't amount to international transaction. That stand we can take, or we can say that there is no requirement to determine the ALP. India has in its regulations, sections or rules not said that shareholder activity is not an international transaction. However, we have the United Nations Transfer Pricing Guidelines 2021. There in para 3.13.4, India's official position has been recorded that India believes the shareholder service, duplicate service, and incidental benefits from group service do not give rise to intra-group services requiring arm's length remuneration. I believe the shareholder service argument is still a valid argument, and if it can be proved in the facts of a particular case, the stand can be taken. The corporate guarantee is not an international transaction, need not be benchmarked by the logic of shareholder activity and not the logic of contingent liability having bearing on profits. Then last and residuary question is how to benchmark corporate guarantee. We have seen the TPO calling for the rates for bank guarantee from the banks, Indian banks, and then applying the average of that to determine the rate for corporate guarantee. We have number of judgments saying that the corporate guarantee and bank guarantee are two different transactions. You cannot apply bank guarantee rates to arm's length corporate guarantee, because in bank guarantee, no bank would give you the guarantee without any lien on some property or some assurity. Whereas corporate guarantee is always given without any assurity. It is because of you are part of my group, I am giving that guarantee. And hence, bank guarantee on principles cannot be applied, the rates cannot be applied for corporate guarantee benchmarking. Now, generally, post the Bombay High Court ruling, 0.5% is an acceptable arm's length. So basically, this is to avoid all the litigation. I would say median is formed that if you apply 0.5% as a markup, guarantee fee of whatever loan amount, that is acceptable as an arm's length without any further benchmark. So practically, this call is being taken. With this, let's move to the next category of transaction. These are, I think, the slides will be shared with you. There are certain parameters which should be kept in mind while determining the ALP of corporate guarantee. This is also a pain point, I would say, for the companies. There are various transactions of reimbursements which are happening day in, day out between the companies. Always we are in dilemma whether I should charge markup, and that is the requirement of PP provisions, or I can treat them as a pass-through cost and they can be repatriated without any markup. The case study succinctly captures this in 4 different scenarios. So you are a Globe Service India, and current year you have reimbursed 4 different expenditure without charging any markup whatsoever. First is a travel expense. You have booked the flights and hotel for employees of the parent company's employees who have visited in India for their project. Second category is you have procured some software licenses for group wide. For entire group, you have procured the licenses. You did the administrative efforts, contract negotiation, and technical integration with the party vendor. Then you have allocated the cost to the respective entities based on the licenses given, but you have not charged any markup. Third is the legal fee. So there may be some, you have engaged some Indian legal law firm to handle compliance issue of your US company, Globecom. It involved the coordination with some that licensing with that law firm, providing the required documentation and managing that engagement. So there is some invoice from them. That invoice you paid to them, and that invoice you charge back to your group company without any markup. And last category is purchase cost. So what you have done, you have purchased goods from the Indian vendors, third-party vendors, and immediately you have sold them back to your US company on back-to-back basis. For this also, you have not charged any markup. Now, the transfer pricing officer is saying that these are not pure reimbursement transaction. You should have charged markup. These are service transaction, and we impute now in cost plus some markup additions. Now let's analyze them in detail. Each of these expense categories are carved out in a manner to give different flavors. The first one, reimbursement of travel expenditure. See, this is on behalf of parent company and for a particular project. When their employee came as an Indian branch of them, you have done that. Immediately you have charged them back. You have got it. If the frequency of transaction is not much, it is rare phenomena happening in a year, you can still say that it's a pure reimbursement. This is a flight cost which is charged to me. This is what I have recovered. That's all. However, if it's a routine feature that every week or every now and then the foreign company employees come, they have project in India ongoing basis for years and years, and this is the regular feature of what you are doing, then I think you cannot take the stand that I am not providing some service, because which third party will give this kind of service for continuous 2-3 years or on continuous basis without charging anything? Because your admin cost is there. You have to coordinate with the flight, you have to coordinate with the employees traveling, etc. For this, some markup should be there. Though you may call it as a low value added services, but some markup should be charged in that fact pattern. So it all depends on the facts. Let's go to second category, reimbursement of software license. Procuring the license and allocating them between different group companies require the efforts. You have also negotiated contract with the vendor. You have also communicated them what is the technical requirements and integration process required. I believe certainly this amounts to certain value adding service given by the Indian company. And if that be the case, not charging markup, I think is not correct. There should be markup charged for this kind of service provided. How much it can be? You can claim that it may be a low value added considering your contributions are not much, but it is for sure that you cannot say I will not charge any single penny. Next example is of legal fees. See, the legal fee, you have only liaised with the Indian law firm for some legal dispute of the parent company, and you just coordinated with them, provided documents, managed the engagement. Now, see, if your involvement is very minimal, and again you are acting just as a paying agent, because see, for making payment to the Indian law firm, they'll have to remit the money and they'll have to receive and all those things. So parent entity says simply that, okay, India, you please pay now, and they'll later on just raise the invoice on us. So if you have only acted as a paying agent, India can claim that I am a pass-through, no markup is required. But India has involved regularly in licensing, providing documentation, discussion with them, and overseeing entire arrangement. I think department can claim, and rightly so, that markup may be required, though as a low value added. And the last category, purchase cost. So what is a transaction? India is facilitating a transaction of purchase from local vendors and selling it to the foreign company. And what India is doing in between? It is placing the purchase orders and arranging the logistics. But it is not taking the inventory. It is directly going to the foreign company. But can they say, I will not charge anything? Again, if it is a one-off transaction happening only for one time, you can say so. However, if it's a regular feature and it is happening over a period of time, I would say it is a service and there has to be markup on the same though it may be as a low value added service. One more aspect is if India is also bearing the inventory risk, credit period risk, forest risk, or using its warehouse to provide these services, checking the quality of the raw material, etc., then you are not actually also providing low value added service. You are doing and providing proper full-fledged service. And in that sense, you have to have markup charged. You cannot say, I have taken it, I have just given it to the US company, and whatever I have paid to the vendor, I have recouped. That's all. No, markup needs to be there under the transfer pricing provisions. Then we move to the another interesting area of transfer pricing is loss-making entities in transfer pricing. There are multiple reasons why entities make losses. We will see some reasons in the case study, which is specifically curated to see the nuances arising, because generally it is said in transfer pricing, you cannot have losses. If you have losses, there is the sure shot TP adjustment. Let's see the facts. Novatech is the Indian subsidiary of Novatech Inc. It operates the electronic manufacturing sector. And it has incurred the significant losses of 10 crore rupees in 22-23. Now, what led to these losses? Certain reasons are given. That it was in its startup phase. The company was established only in 2020 and it is still in the market penetration phase. Second was there is very high R&D cost. Since it is in the initial years, you are developing new product lines. The R&D expense is as good as 20% of total operating cost, which right now you are not able to recoup, and hence the losses. Thirdly, there is economic downturn also. The electronics industry is facing the reduced demands. And lastly, there is a forex loss. What has happened? The rupee is depreciated against the USD, and hence there is a forex losses on import transactions. Now, how you have benchmarked? The Indian company has benchmarked these under the TNMM. So their unadjusted PLI is loss of 10%. Operating profit to operating cost is 10%. What they have done, they have taken certain adjustments. They have taken the adjustments of capacity because they say we are not fully able to use my full capacity. So I take the capacity adjustment. I have taken the depreciation adjustment. I have taken the import duty because I have substantial imports. Considering all these adjustments, your adjusted PLI is 7.5% profit. Comparables median arm's length is 5%. So in your TP study report, Indian company has concluded that my margins are at arm's length. Now, when TPO verified this, he has raised the issues of losses. He says, I reject your benchmarking because the losses of yours are mainly because of your transactions with your group company and not because of the other reasons which are citing. Ultimately, he rejects your loss. He rejects the adjustments which you have carried out, capacity adjustment, depreciation adjustment, custom duty adjustments. He runs the fresh benchmarking. He finds the comparable margin arm's length at 12%. He compares that with your loss of 10%. So he proposed the adjustment of 22% and made the addition of 12 crore rupees. Now, in this fact pattern, what situation or issues arise and how to deal with them? The first and foremost is whether to have losses is valid proposition under the transfer pricing regime. Can it be considered as a genuine and bona fide, or it will be always considered as you are not at arm's length pricing if you are in losses? Rule 10b(2) says that comparison of transactions should be based on market conditions and business strategy. As we have seen in the case study, I am trying to penetrate the market. I am into second year of my existence. And rules and OECD commentary also acknowledges that business strategy should be considered. So business strategy, if you have documented all records are there, there are communications available, contemporaneous data you have maintained. I believe there is a scope to say that losses can be justified under transfer pricing. But documentation and contemporaneous documentation is the foremost key. That has already been upheld in the case of L'Oreal India by the Mumbai Tribunal, that losses can be due to business strategies. Then we come to the next aspect. The TPO has rejected my capacity utilization adjustment and depreciation adjustments. What about that? So for example, say my capacity is of 1 lakh units, but since I am in a startup phase, demand is less, I am only able to sell 20,000 units. So my capacity utilization is only 20%. 80% of capacity I have, but I have not utilized, because of which there is a under recovery of fixed asset which are incurred. And hence, if you are in a startup phase, courts have recognized that you can very well take the capacity utilization. However, we have seen certain companies practically who are in 10th or 15th year of their existence in India, and they are still into losses. There you cannot say that for 15 years, I am operating at less than my capacity because there is no demand. That indicates there is something in the pricing of intercompany. So which phase you are in, startup or already existence, that also matters for defending the capacity utilization adjustment. Higher depreciation, yes, since you have just set up the entities, you have your fixed costs are high, your depreciation are high, and if you are comparing with the comparable who are already in existence for 10 year, 15 year, the depreciation cost has started diminishing. So to make them at parity, I should be given the depreciation adjustment. That can be very well taken argument, and it's supported by the tribunal rulings. You can also take, in the case of loss-making entities, the adjustments such as forex, demonstrating how rupee has been volatile and how rupee has been depreciated against the USD or any foreign currency, resulting into losses. We have seen practically that it has been accepted and that adjustments are given, and to that extent losses are being accepted. Regarding the custom duty adjustment, the argument is, see, my 90% raw material is imported, so I am paying the custom duty to government, which other local suppliers are not paying, and hence I should be given the custom duty adjustment. Unfortunately or fortunately, in the annual accounts, companies are not required to say that how much is your custom duty and how much is your import percentage. That we can only decipher from the going through financial on broad basis. Generally, TPO's argument is, every company has some imports, you're not the only one, so you should not be given the custom duty adjustment. However, based on data, if you are able to justify that, see, my custom duty percentage to total purchase cost is say 30%, and custom duty percentage of comparable is say only 10%, then the 20% additional custom duty which you are paying, that will obviously reduce your profit margins and may result in losses. And in that situation, you can very well take a ground that I should be given custom duty adjustment. However, again, mind you, if it is in the initial phases, this ground is okay. But say you are established for 10, 15 years and still you are taking this ground, generally courts are not inclined to allow that, because they say you should try to indigenize your model. And for long 10, 15 years, if you have not done that, sorry, we cannot give you the adjustment. Many times losses also arise due to certain extraordinary situations or one-time settlements which happen and which results into the huge expenditure in the P&L account. If that is the case, and that particular expenditure does not reflect the core operating performance or functions of the company, for example, you're a manufacturer, and one-time extra cost is for some legal disputes, huge cost, because of this is losses. You can very well say that this is an extraordinary expense or non-operating expense, this should be excluded from the cost base while computing the margin. And without that, my margin is at arm's length, and hence there should be no adjustment required. So in that case, when you calculate the profit level indicator PLI, this cost should be excluded. So these are certain things which we have discussed, that if you are a loss-making company, you can take these approaches or stand, and that may give you some argument or talking point to justify your losses. Deepika ji, do I have more time, or we should give time for question answers? Because I think there are 2-3 more points pending, but it will take another 15-20 minutes for me to complete. Deepika ji, or anyone from the organizer side?
Yeah. Yes, tell us.
Should I continue, because it will take another 15-20 minutes, or should we take the question and answer? What would you suggest?
So we can take question and answer as of now.
Okay.
If anybody has any questions, they can put it on chat box. So you can clarify to them.
Okay. Okay. Or otherwise, participants can raise their hand and we can have them. They can. Let's see whether there is any question. If you have any question, kindly put in the Q&A. I think Q&A. Yes. Can you throw some light on secondary adjustment and how they operate under Indian TP laws? So yes, the secondary adjustments are very well part of the Indian TP regulations. We have the documented provision for the same. However, there is no litigation or dispute as such as of now. It has reached to the tribunal or any higher forum. There are multiple issues with respect to computation, when it is applicable. However, I think the question is very generic. So I think I may not able to answer any specific about the question. What are the documentation that we must keep when there is subsidiary company, which is only the cost center in India, and A are in foreign, which are reimbursing costs in India? Yes, so some documents, I would say, if like we have the example, travel cost, you must have the flight tickets, you must have the email communication which has happened with your AE, that see, this is X person is coming for this project, he will be visiting this and this place, his travel needs to be arranged. This kind of email communication should be preserved. Plus, you should also see that whether you have a dedicated employee to take care of that activity, and if that be the case, his cost also need to be seen while charging markup or not. If he is doing for one time, or you have dedicated office team for your local existence also, and while doing that, he is doing one of the booking for your parent company, then that may be a different case. However, these kind of documents, at least direct third-party documents which you have, invoices, bills, email communication, those should be kept. Could you share some insights on the most widely used benchmarking tools for transfer pricing and how they help business ensure compliance and competitiveness? Yes, it's a very good question. The most widely used benchmarking software is for PNMM, I would say. The net profit benchmarking approach is Prowess. That database is also being used by the department. Apart from that, there are two more, which is ASTP, and we have the Capitaline as well. I think for Capitaline, ICI has some arrangement with for its member, it is available at discounted rate. However, they are not being used by the department. And nowadays, we are seeing a growing tendency, which is in almost every case which is before them for TNMM, they are running their fresh search on Provis. So it is recommended that in order to avoid latter moment or at the time of audit discrepancies, Provis should be the best database for TNMM benchmarking. For royalty or interest rate, so interest rate, we don't have any Indian database, though we have some database of NSC for some debenture kind of agreement. For loan per se, we have, there is a foreign database of loan connector, which can be used, which is department also uses that. For royalty rate benchmarking, there is a database of royalty stat. We don't have any Indian database for royalty benchmarking. It's only the foreign database. This royalty stat, loan connector, these are extremely costly databases, and so they are less widely used. However, the Provis and these are for Indian benchmarking. Can you provide more guidance for the company which is in losses for many years? What stand we can in that case? Yes, as we have discussed, if your company is consistently into losses, 2-3 things you have to give attention to. First, what are the business reasons for that situation? You have to have documented reasons. For example, Ola or Uber, they come with a dedicated strategy that for 5 to 7 years, we will be in losses. We are not going to generate profits. But they have a model that post 7 years or 10 years, we will be into profits. So this kind of strategy has to be documented. If that is not the case, because we have seen in one of the client, it was a manufacturing company. Despite 12 years of its existence, it was into losses. The reasons were mismanagement, inefficiencies. One of the reasons was the group company was charging the cost at whatever transfer pricing rate they should have. So their interests were protected, but Indian entity was not able to create that demand. And that demand creation was due to their inefficiency. Now, it is critical that you cannot, or it's very difficult to factor in your inefficiencies, management inefficiencies, to say that my loss is justified. Department generally don't accept that proposition. However, capacity or this kind of forex depreciation, probably these kind of arguments can be taken, but my experience, at least for a couple of entities, before lower authorities and till DRP, it is not acceptable. Then we have, do we have to benchmark payments of managerial remuneration paid to KMP? If so, what kind of database are in use? So first and foremost, are you talking of KMP who are residents, or are you talking of KMP who are non-residents? If you're talking of KMP who are residents, now 2012 onwards, I think it is no more an international transaction, so it need not be benchmarked. It will cover under your 48(2)(b), and there you will see it. If your KMP is a non-resident, for example, you have a director who is a non-resident, you are paying director fees to him. Generally, there is no such database which is in use, because it is very, there is no particular database for these kind of things. Generally, they are benchmarked under TNMM. These transactions are aggregated under TNMM and they are being benchmarked. But otherwise than that, if you have some, now we get some industry study. For example, if I am hiring a CEO, we can get it done from the associations that how much should be the salary of a CEO I am looking for. We get such kind of reports. So if you get such kind of report and that says, for example, you can pay between 1.5 CR to 2 CR and you are paying 1.75 CR, I think that should justify your benchmarking applying the other method. Then we have a question which says, sir, what should be the reasonable markup for reimbursement of expense like traveling, coordination? Yes. OECD has one concept which is low value added services. if your services, and I believe these kind of services are low value added services because your main business is manufacturing or trading or service, this is ancillary aspects of it. It amounts to low value added services. OECD says that if service is low value added service, you need not undertake a fresh or separate benchmarking study. Cost plus 5% markup is sufficient. So you need not incur a separate benchmarking study, determine the rate because cost is higher. So they have done the cost benefit analysis. So if low value added services, you can take the markup of 5%. That is the safest. Then we have a question, parent company gives loan to subsidiary and after few years waives the repayment of this loan. Using shareholder activity argument, TPO is challenging this stand. Any thoughts on how best to argue this issue? The question is shareholder activity. As we have discussed also, you have to prove how the stand which the parent entity has taken, it is in the best interest of the shareholders. If you simply say there is a loan waiver and it is the interest of shareholders, nothing else, I think TPO may not accept that stand. But for example, you are able to prove that why there is a waiver of loan, because there may be certain circumstances. Because when you have given the loan, you would not have imagined that this loan has to be waived off. So there must be certain situations, business realities, commercial compulsions, which have resulted into this kind of situation. If you can document this, and then you can link it with the interest of shareholder, saying that, see, if I would not have waived this loan, then the existence of company would have at stake. And my worth investment of say 500 crore in the company would have become 10 crores. So I am having a risk of 490 crore of devaluation of my investment as a shareholder. And if this point you are able to put forth in numbers, then I think you have a case to argue before the authorities. I think I have answered all the questions. If any question, there's one more, I think. No, I think I have answered that also. Is there any question? So otherwise, I give mic back to Deepika ji. Thank you so much. I'm really grateful for patient listening, and this was a very interesting opportunity for me to share my thoughts. And as I said, it's an opportunity to learn from the interactions. So this is really, I'm grateful to the WRC for this opportunity given. I have given my contact details on the screen. I can be contacted at this number if required.
As we bring today's enlightening webinar to a close, it's my honor and privilege to extend a heartfelt vote of thanks. I would like to convey our sincere gratitude to you, Piyush ji, because your experience and your invaluable, sharing in terms of all the practical aspect has been, really, really insightful. So we truly appreciate the time and effort that you have invested in preparing and delivering us this entire content. Further, huge thank you, of course, to each one and all who have participated as a member to make this more impactful. Yeah, really thanks to everyone.
I would have one request that I'll share my PPT. I think I could not take up 3 to 4 scenarios. So I think participants may go through and read, and they will be benefited by that. Thank you so much.
Thank you so much.